Okay, we're in Chapter 8 on receivables. The first exercise is number 3, and it reads entries for uncollectible accounts using the direct write-off method. So direct write-off, straight to expense. Journalize the following transaction in the accounts of Canyon using the direct write-off method. January 19, sold merchandise on account $6,400, cost of goods sold $3,000. Well, there's nothing new to this journal entry. Your sales entry, and then your cost of goods sold entry, your cost entry. June 2nd, received $500 and wrote the remainder off. So the $6,400 is going to get credited to AR, and then we did receive the $500 in cash, and the balance goes straight to expense. October 23, now we reinstated it and received this $5,900. So the first thing you do is you put it back into AR, and because it's in the same fiscal year, we credit the expense. We just basically pretend that June 2nd didn't happen, and then we take it into cash and credit AR. Some will say, why put it in AR and take it right back out? If you notice, that's what we're doing here. And they'd say, well, just do the one entry of a debit to cash and a credit to bad debts expense. For all practical purposes, that's fine. For Cengage, you're going to need to do the two entries, first putting it in AR and then taking it back out. Number 4 says journalize these same transactions now using the allowance method. The allowance method. So May 24th, sold merchandise. Again, all we're doing here is that sales and cost transaction. Nothing new. We've done that in all of our chapters. Received $9,000 and wrote the rest of it off. So knowing that we put $24,450 into AR, we got to take it out of AR. We did get cash, so we'll debit cash, and then instead of bad debts expense, we're using the allowance method. Now we debit the allowance for doubtful accounts. On December 7th, we reinstated it. So we're basically pretending as if this never happened. So we put it into AR, credit the allowance account again. Like in number 3, we credited the expense. This one, we credit the allowance. And then, just like we did in exercise 3, bring it into cash and taking it out of AR. Bring it into cash and take it out of AR. Number 5, entries to write off accounts receivable. Creative Solutions, a computer consulting firm, has decided to write off $13,780 owed by a customer. Journalize the entry to record the write-off using the direct write-off and the allowance method. Well, just like we did in number 3, bad debts expense, credit AR. Bad debts expense, credit AR. That's the direct write-off, straight to expense. The allowance method, how do we do it there? Here in the allowance method, right up here, we debit the allowance and credit AR. So here, we debit the allowance and credit AR. Not too bad. Number 6, providing for doubtful accounts. At the end of the current year, the accounts receivable has a debit balance of $1,835,000 and sales of $25,690. Determine the amount of the adjusting entry to provide for the doubtful accounts for each of the following assumptions. So first, letter A. The allowance account before adjustment has a debit balance of $12,500. Bad debts expense is estimated at 1/2 of 1% of sales. 1/2 of 1% of sales. All right, so let's look at letter A. It says here bad debt expense is estimated at 1/2 of 1% of sales. So in letter A, we take this total sales 1/2 of 1%. So in this case, all we do is we debit our bad debts expense and we credit the allowance account for $128,450. So what we're doing actually in number 6 is setting up that allowance account. And as you read in your chapter, there's two basic methods or angles of looking at this allowance account. The first is a balance sheet approach, and the second is an income statement approach. Well, letter A is an income statement approach because we are looking at sales. And the big deal there is we don't care, make sure you hear this, we don't care what the balance was in the allowance account. We just book what we calculate. So in letter A, what did we do? We just booked $128,450. Is that going to be the balance in the account after we're done? The answer is no, because it had a beginning debit balance of $12,500. We could never have a debit balance in the allowance account because if you remember, AR is our asset debit balance. The allowance account is the contra account. It reduces. So if we have a debit balance in the allowance account, essentially your net number would be AR plus the allowance, because it's a debit, for even a higher amount. Well, that makes absolutely no sense. It should be AR minus the allowance account, and that would give you the net. Okay, so that's letter A. Let's jump to letter C. The allowance account before the adjustment has a credit balance. That's what it should be. It should always be a credit. If it's a debit, it means only one thing. We wrote off more than what we expected. We wrote off more than what our allowance account was set up for. So in this case, it's got a credit balance of $26,810. Bad debts expense is 3/4 of 1%. So here we go. 3/4 of 1% times that sales means we book $192,675. Pretty straightforward. Now let's look at B. The allowance account before the adjustment has a debit balance. Again, that's not what we want. An aging of accounts receivable. So compare that to A and C. In A and C, we're looking at sales approach, income statement approach. Letter B, we're looking at AR, which is on the balance sheet. So it's a balance sheet approach. Well, in this case, it says bad debts, an aging of AR of accounts in the customer ledger accounts. That estimated doubtful account should be 162. That's what we want it to be. Well, unfortunately, there's a $12,000 debit balance, so we got to add that also to get to our $162,000 balance. By booking $174,500, we will be left with a balance of $162 because we had a debit balance. So adding $12,500 to that debit balance already would just get us to zero. As a debit balance of $12,500, we put a credit balance of $12,500 in there. That gets us to zero. Plus another $162 will leave us then with $162. Letter D is also an aging of accounts receivable approach. Here it says they want us to have there is a credit balance of $26,810, and they want us to have $171,200. Well, if there's already a credit balance of $26,810, then we need to just calculate the difference. $171 less $26,810. We need to only book $144,390, and we will be left with $171,000 because we already had a credit balance of $26,810 in the account already. Make sure you take some time to look over number 6, as there's two approaches. A and C is that income statement approach. We don't care what the balance is. B and D is a balance sheet approach. We do care what that ending balance is. That's really the only difference. All right, let's move on here to number 11, estimating doubtful accounts. Okay, so Outlaw Bike is a wholesaler, an aging of accounts receivable. So if we're looking at aging of accounts receivable, that's a balance sheet approach. A historical analysis of percentage of uncollectible accounts in each category is as follows. So all we do is we take the balances in each category times the percentages given, and we get to this 63,410. In this case, we don't know what the beginning balance was, so all we would do is book, bad debts expense 63,410, credit the allowance account for 63,410. Number 12, it says here, using the data in exercise 811, assume that the allowance for doubtful accounts had a debit. Well, we're doing a balance sheet approach, right? Balance sheet. These are AR accounts. Well, then we take that 63,410 plus that debit balance to get us to a 63,410. It's exactly like the number 6 exercise, literally letter B. So what do we got to do? We got to book 68,550 to the bad debts expense and credit to the allowance account, and we will be left with 63,410 due to that debit balance. We'll take a break there, and then we'll continue on with some of the exercises from Chapter 8.